Hi everyone, welcome back to the US individual taxation classes. This is Enroll Agent Part 1, Income and Assets. This particular video is in continuation of the previous two video which you have watched on cost recovery. This is third part of the cost recovery, and here we'll be covering two important topics, which is depletion and amortization. So let's dive into to understand more in detail about depletion and amortization. Hi everyone, welcome to the US taxation for individual chapter 2, almost the last class for chapter 2. So in today's class we'll be covering like depletion and amortization. That's a lot, and then there are some other miscellaneous topics. So those all we'll be covering today. So depletion is basically for those natural resources like oil, gases, or maybe you can say minerals, or maybe coal or mining, such kind of product which are being, like natural resources are being available, right? So for them, we calculate, instead of depreciation, we can consider depletion, because as and when we are extracting those oil, natural gases, coal, and other natural resources from the either from the seabed or maybe from the ground, so these are like quantity is reducing. So the quantity is reducing, that means we are depleting those assets, those natural resources. That's the reason it is called depletion of assets rather than depreciation of assets, right? So it is the process whereby owners of the economic interest are natural resources, and they may recover loss from their investment like oil, gases, minerals, timbers, coal, etc. Right? So there are two methods given for the depletion. First one is cost depletion method, and the second one is percentage depletion method. So cost depletion method, here we understand how much is the total cost we have paid for the purchase of the particular asset. For example, let's assume you purchase a coal mine. How much money you have paid for the purchase of that coal mine, and how much estimated coal you are expected to extract from that coal mine, right? So the total cost is being divided by the estimated number of unit to reach at per unit depletion cost. So that is called cost depletion method. For example, if you have purchased a coal mine in which you are expecting, let's assume 100,000 metric ton coal, and you purchase it for, let's assume, $1 million. So $1 million divided by 100,000 metric ton will give you per metric ton cost of the coal. So whatever the number of unit you will be extracting, so you will be applying the same rate to based on the extraction and amortizing over the period of time as and when you are extracting the coal. Got it? Any doubt? What is cost of depletion method is? Or you want me to do
Yes, sir.
a quick example? You see, for example, you have purchased a coal mine. Coal mine or gold mine? What you would love to purchase?
Gold mine, sir.
Gold mine. Okay. So let's assume you purchase a gold mine for how much? $1 billion. Right? For $1 billion, you purchase a gold mine. In that, you are expecting estimated gold, let's assume 500,000 kg, right? So depletion cost per kg of gold. How much will be it? This divided by this $2,000 per kg. Are you agree with me? Are you guys with me?
Yes,
right?
sir.
So in year one extracted, let's assume you have extracted 50,000 kg. 50,000 kg. So in the year one, how much is the depletion cost? 2,000 multiplied by 50,000. Are you guys with me?
Yes, sir.
How much is the depletion cost? 100 million. Right? Are you guys agree to it?
Yes, sir.
Yes, sir.
So that's how like depletion is being booked. Right? Cost of depletion unit is equal to total cost or adjusted basis divided by estimated number of unit you are expected to extract. Depletion cost of the period. How do you calculate depletion cost of the period? Number of unit extracted multiplied by cost depletion per unit. Same way how we have calculated, right? So note over here is cost depletion no longer applicable when the adjusted base or cost is reduced to zero. For example, in this example, let's assume in year 1 to 10, you have extracted the entire 500 kg. So in year 1 to 10, depletion cost you have incurred how much? Entire $1 billion, right? Are you guys with me? Hello? Right?
Yes, sir.
But now when you have extracted all 500 kg, what you still see there is additional 50,000 kg available still available there. Then what you will do? Are you getting my point? So at the time of the purchase, you have estimated that 500,000 kg of gold might be extracted from this mine. And you have extracted all 500,000 kg, but still you see there is more gold available, which is how much? 50,000 kg. Then what will be the depletion cost after that? If you are using cost of depletion method. What's up?
डिप्लीशन कॉस्ट सर थोड़ा कम हो जाएगी थोड़ी.
No, depletion cost. Will there be any depletion cost?
डिप्लीशन कॉस्ट
होनी तो नहीं चाहिए.
होनी तो नहीं चाहिए.
Why?
क्योंकि जितना एस्टिमेट किया था उतना तो निकला है, उससे ज्यादा निकला दो.
बाकी ये कि कम हो जाएगी हमारी अगर पूरा करेंगे उससे. पहले जो हम सोच के चल रहे थे 2000 निकले आएगी, वो उससे कम आएगी.
Look at this. Read this note. Read this point carefully. What it says.
सर उसकी कॉस्ट तो कवर हो ही गई है, तो कॉस्ट डिप्लीशन नहीं लगेगा इसके ऊपर।
Right? Agree, everyone?
Yes, sir.
And what is the second point? Cost basis must be reduced every year by depletion amount, whether by cost or zero. Right? That means if in year one you have extracted 50,000, so your depletion amount is 100 million. So what is the book value after year end? What is the book value will be this minus this $900 million, right? Everyone agree? Yeah. Make sense, everyone?
Yes, sir. Just minus the depletion cost, right?
Simple, right? So book value at the year end would be $900 million. That's what this second point is. Cost basis must be reduced every year by depletion amount, whether by cost or percentage method, whatever the method you use. Right? So we understood what is cost depletion method. Any doubt here?
No, sir.
No, sir.
Right? Yes. Good, everyone? Okay.
Yes.
Now look at right hand side. Percentage depletion method. So here, in the lesser of the following two amount, you need to consider as the depletion expense. First one is percentage specified by the Internal Revenue Code, IRC, on a gross receipt basis. So there are certain minimum percentage, certain percentage is also being defined in the IRC, right? Do you remember, like in India also, earlier in the Companies Act, there was some defined percentage for depreciation, if you remember from your school days. But nowadays, it's more on estimation basis. But in income tax, if you see in India, there also certain percentage has been defined for respective category of item to depreciate. Same way, IRC also provides certain percentage on a gross receipt basis, that is on the sales basis. So how much amount of the item you are extracting and selling, right? Whatever is your sales price, certain percentage of that price you need to consider as a depletion cost. So that has been defined in the IRC in itself for different material at a different rate. So for example, copper may be 15%, silver maybe 25%, gold maybe 30%, 40%. So different kind of minerals or different kind of products have been categorized in a different rates by the IRC itself. Or 50% of the taxable income from the property before taking depletion deduction. Make sense? Are you getting this point?
Yes.
Yes, sir.
So let's look at the example. Here we have a sale of $100,000, and you have a manufacturing cost of $10,000. You have a labor cost $20,000, and you have overhead of $30,000. Let's assume you have a gold mine. So for gold, you have sold for $100,000, on which the gold you have extracted, you have done certain processing on it, right? So the processing cost include manufacturing cost, labor cost, and overhead cost. Then finally it become a jewelry which you have sold for $100,000. So here, if you see sales minus manufacturing cost, labor cost, overhead cost is your taxable income before depletion. That is how much? $40,000? Yes or no?
It is before the depletion.
Hmm?
Like it is before the depletion amount.
Yeah, that's what it means. Like first you need to identify taxable income before depletion, right? And then you need to apply this point number 1 or 2. So point number 1 says depletion is lower of 15%. Let's assume 15% is the rate defined by the IRC. 15% of the gross receipt, which is how much? 15% of 100,000. How much is it?
15,000.
$15,000. And
Yes.
second option is 50% of the taxable income. How much is the taxable income before depletion? 40,000.
40,000.
Right? 50% of the 40,000.
20,000.
20,000.
Basically,
So you need
whichever
to
is
select lower of these two.
lower amount.
So which one is lower of these two?
15,000.
So your depletion expense will be $15,000. Make sense?
Yes, sir.
So this is how we need to use percentage depletion method. If we are using percentage depletion method, then this is how we need to do the calculation to identify the amount for depletion expenses. Right?
Sir, I have a small doubt. So it's like the first point, 15% of gross rate is specified by IRC. It is basically amount taking of the sales, right? Or some
Yes,
other
yes,
amount.
yes, yes. 15% of the gross receipt means sales, which is
Sales.
100,000.
Okay.
Anyone? Any doubt? Shubham, Rajat, Garima. So far, so good?
Yes, sir.
Now, look at the note over here. Percentage depletion is not restricted to cost basis. So this is the benefit over here. That means you can claim depletion even after 100% of the cost you have absorbed. So this is the additional benefit of using depletion method. What it says, percentage depletion is not restricted to cost basis. Taxpayer can recover through the depletion deduction for more than they have invested in the resources. The excess taken become a tax preference for alternative minimum tax. In the alternative minimum tax, it will be add back, but for normal tax purpose, you can allow as a deduction. So for example, let's go back to this one. The same example, let's assume you have invested $1 billion to purchase a gold mine. Now you are applying this method. Which method is it? Percentage depletion method. So here, let's assume you have total cost this much. Let me do this. So let's do this here. So you have total purchase is $1 billion, and the sales in year 1, let's assume you have made a sale of $50 million. This is what the sales you have made, let's assume. Right? And then you have IRC rate. Let's assume 20%. And then you have manufacturing costs, then you have labor cost, then you have overhead cost, right? And yeah, so these all information, let's assume given. Manufacturing cost, let's assume you have $10 million, and you have labor cost, let's assume $12 million, and overhead cost, let's assume you have $3 million. So this is the total cost you have, and 20% is the IRC rate. So in this case of scenario, what will be the depletion for year 1? What will be the depletion for year 1? First, you will be calculating 20% of
20,
sales.
15.
Huh? How much is the sale? 50 million into
50 million.
20%, right? So
10
this
million.
is $10 million, right?
Yes.
Or
40%.
the other thing is, what is your income?
50% of
50% of income before depletion, right? So how
Yes.
much is the total income? You have this minus manufacturing cost minus labor cost minus overhead cost. Right? And then you have 50%. Right? $12.5 million. So which one is lower?
10 million.
So depletion
10
amount is how much?
10 million.
10 million. Depletion amount is $10 million. So that's how you do the calculation. And now let's assume let's assume the sales in year 2. So this is, let's assume, year 1, and this is, let's assume, year 2. In year 2, let's assume you sold this much amount, and your cost of manufacturing is let's assume you have 400,000, and cost of labor is also, let's assume you have 500,000, and cost of overhead, let's assume you have 200,000. So in this case, you have 20% of sales is your depletion. Yeah, so let's assume $5 billion is the amount at which you have made the sales. And then here it is 20% of that is $1 billion, and you have 50% of this is coming as $1.95 billion. So the actual depletion you will be considered is how much? Minimum of these two, right? $1 billion.
Yes, sir.
Are you guys with me?
Yes, sir.
Yes. Yes.
Sachin, Vivek, Rajat?
Yes, sir.
So now if you see the total depletion is equal to sum of this plus this. So this is more than the cost,
Yes.
right? This is more than the cost. So in the percentage of depletion method, that situation can be possible. And you can claim the depletion expenses more than even the cost. Make sense? Are you guys with me?
Yes, sir. Yes.
तो ये कितना भी फर्क हो सकता है फिर तो सर, कोई लिमिट थोड़ी है।
Yes, that's what they said.
हम्म,
So, but this is for normal tax calculation. But when you do alternative minimum tax, in which you need to pay bare minimum tax, then this $10 million will add back. In case of AMT, in case of AMT, alternative minimum tax, you need to add back how much? This much amount. You need to add back to the income, and for on this you need to pay minimum tax, which is 15%.
Sir.
Hmm.
So like, do we have to mention कि we have taken 20% of sales or 50% of income?
This will be given to you in question.
And the depletion is on basis.
So say that again.
Like sir, like I had a doubt if both of the amount came same. Like.
So you can choose either one. It does not
Okay.
make any difference.
I thought do you have to write the depletion of year one? We have taken 20% of sales or 50%.
No. Like every year you need to do the separate evaluation. Whichever come lower, you'll be selecting
Yes.
that.
Okay.
Very good question. Right, everyone? Got it? So here are some common depletions rate given. 15% for copper, gold, silver, iron, oil, and gases. 10% is for coal, and 5% for gravel, peat, sand, something like that, right? Generally, the percentage of depletion is not available for oil and gases, well, and for timber. So that's a small note for you. But in your exam, for your exam purpose, this percentage will be given to you in the question, right? So any doubt on cost depletion method or percentage depletion method? Vivek, Sachin, Shubham, Rajat?
yes sir, yes sir.
Mayank, good?
Yes, sir. Yes.
Okay. So now depreciation and recovery allowance recapture. So this we have studied earlier also, section 1231, 1245, 1250. It's kind of quick repetition of the same. So 1 second. Do some formatting stuff. Right, section 1231 provide the long-term capital gain treatment, which we have discussed earlier also. So if then asset is being for the business purpose use for, and you are selling those assets, you can consider that capital gain as a long-term capital gain. Whereas 1245 and 1250 says about recovery of depreciation. So if you are using any asset for a business purpose on which you have claimed the depreciation, to the extent amount of capital gain you are recovering from the depreciation, that amount need to be considered as ordinary income and need to be taxed at higher rate. That is coming under section 1245 and 1250, which we have discussed earlier also. Then 1231, property is a real or depreciable business property held for more than 1 year. This is always be for long-term assets, whether it's land, building, machinery, equipment, timber, livestock, or any such asset. 1245 and 1250 were enacted to close the loophole that result from allowing the depreciation deduction on the assets to offset the ordinary income while taxing the gain at lower tax rate. So that's we have already aware of. 1245 recapture the gain as ordinary income to the extent depreciation was charged earlier. 1245 applies to the personal property, which is machinery, equipment, furniture, automobile, computers used in trade and businesses. Any gain beyond earlier depreciation is considered as a capital gain under section 1231. Depreciation recapture rule do not apply when the property is disposed of by gift or by estate, which is like transfer in the case of death. When transferring any property to the charitable institution as a charitable contribution, then consider the fair market value is the value of charitable contribution as a deduction. Gain on tax-free exchange or involuntarily or casual conversion, that gain is being considered as the ordinary income up to the amount of depreciation charged earlier. So any amount over and above would be considered as a capital gain. Installment sale. So any depreciation is recognized in a year of sale even if no proceeds are received. So in case of installment sale, which we have discussed earlier, so it's kind of repetition of the same. So for example, you have equipment you have purchased for $100,000, and that equipment you have sold on 31st December 2003. That means after 3 years, you have sold that equipment for $110,000. Right? On that equipment, you have already charged the depreciation for 2001, 2, and 3 of $60,000. So you have a net book value of that equipment is 40,000. How you calculated 40,000? How have we calculated this 40,000?
So 1 lakh minus 60,000.
Yes, absolutely true. So 100,000 minus 60,000 is your book value. So now in your books of accounts, you have that equipment value of 40,000 and you sold that equipment for 110,000. Right? So you have a capital gain. You have a total gain of 70,000. 110,000 minus 40,000 is equal to 70,000. Right? Yes, no?
Yes, sir. Yes.
Right? In that 70,000, you have 60,000 relating to the depreciation which you have recaptured and 10,000 over and above. So that 60,000 on which you have already claimed the depreciation expense in the ordinary income and expense, that need to go and consider as ordinary income to be taxed at 25%. Right? Over and above, you gain $10,000. That is your long-term capital gain under section 1231. Make sense? This 70,000, out of this 70,000, 60,000 will go into the ordinary income and 10,000 will go into the long-term capital gain under section 1231. Make sense?
Yes,
This we have done, yeah. This we have done earlier also. It's
Yes,
not
sir.
new. Section 1250 applies to the real property. Real property are land and buildings and leasehold improvement. So gain on sale or exchange of real property. So up to depreciation deduction taken in the earlier year, consider section 1250 gain and tax at a special rate of 25%. Over and above the depreciation would be considered in 1231 gain and tax as a long-term capital gain. Same way how we have discussed above example. Additional rule for the C corporation under section 291. This is not for S corporation, only for C corporation. C corporation ordinary income from sale of 1250 asset, which is real property, will be increased by 20% of the lesser of depreciation deduction taken or recognized gain, whichever is lesser. Right? So what it says, there is a special provision of section 291 which says the ordinary income from the sale of real property will be increased by 20% of lesser of these two items on account of section 291. That is applicable only and only for the C corporation. Right? So first, from the above example which we have discussed, we are continuing the same example considering that is for the C corporation. So your sale was 110,000, right? Your cost was 100,000 and you have a depreciation of 30,000. So you have a realized gain is 110,000 minus 70,000, $40,000, right? This is given as an example or information to you in example. First is recognized gain. So recognized gain as ordinary income under section 291 will be lesser of these two. 20% of the depreciation. How much is the depreciation charge? $30,000. Yes, no?
Yes, sir.
Right? 20% of 30,000 is how much? 20% of 30,000 is
$6,000.
$6,000. Or second is 20% of realized gain. How much is the realized gain? $40,000. 20% of the 40,000 is how much?
$8,000.
$8,000. So 6,000 or 8,000. Which one is lower? $6,000. Right? So we need to consider $6,000. Right? As section 1231, long-term capital gain will be $40,000 minus $6,000. This $6,000 would be considered as ordinary income. Make sense? Under section 291, and this section is only and only for the C corporation. Any doubt on this example or on this question? Yeah, Mayank, Rajat, Sachin, Shubham, all good?
Yes, sir.
Okay, so let's do a quick question. In 2012, John and Kim John, husband and wife, brought their primary residence for $250,000 in 2021. They sold it for $550,000, taking the maximum allowable exclusion. Which of the following statement best reflect their tax situation? So they are saying in 2021, John and Kim John, they have purchased a primary residence for $250,000. And in 2021, they sold it for $550,000. How much is the difference? $550,000 minus $250,000. How much is the difference? How much is the gain? $300,000 is the gain, right? What is the maximum exclusion? And which of the following statement best reflect the tax situation? The couple is able to exclude $250,000. The couple is not able to exclude any gain. The couple is able to exclude $300,000 and is not required to report the sale on a 2021 tax return. And the couple is able to exclude $300,000 but is required to report the sale on the tax return. Which statement is correct and why? What was the condition? Do you remember the condition?
Yes, so they must be holding the house for 2 years out of the 5 years and using the house and for their primary residence, and for individual it's 250,000 and for married it's $500,000 exclusive.
सेकंड
Why?
क्योंकि ना सर इसकी जो 500 वाली लिमिट है 500,000 वाली उसके ऊपर अगर जाती है कॉस्ट तो वो एक्सक्लूड हो जाता है, नॉट एबल टू एक्सक्लूड.
How about others? Rajat, Mayank, Garima. First question is whether the couple is allowed to exclude, and this is allowable exclusion.
So it's mentioned here that they are living like years out of the 5 years. Although ये लिखा हुआ है कि primary residence है उनका.
Let's see. Why is it not finding?
So this keyword is only mentioned here.
No, I think so. Okay. Here we started like sale of personal residence, like the principal residence owned and occupied at least 2 out of 5 tax year in case of married filing jointly, and exclusion from the capital gain from tax for individual 250,000 and for MFG 500,000. The exclusion may be used only once in every 2 years. When husband and wife each sells a principal, the individual is treated as using the property. Very confusing. Okay, let's go back to.
सर ऑप्शन फर्स्ट एंड ऑप्शन थर्ड तो वैसे ही गलत है, और ऑप्शन सेकंड और ऑप्शन फोर्थ में से ऑप्शन सेकंड बेस्ट है.
So I think we need to.
Sir, we have to choose the best option. So
Best right option, yeah.
third to ruled out actually.
So first option is the couple is able to exclude 250,000. This is wrong. Like if the couple is filing jointly, they can exclude 500,000.
300,000, yes.
Right. So third option is the couple is able to exclude $300,000 and is not required to report. That is also wrong. The couple is able to exclude $300,000 but is required to report the sale on 2021 tax return. This looks right to me. If you see the fourth one, the couple is able to exclude up to $300,000 but is required to report the sale on 2021 tax return. Right?
Yes, sir.
I'm still not able to digest why the second option is like bold here. The couple is not able to exclude any gain. So if it's a primary residence, right, at least they have given this information, brought their primary residence. So primary residence means they are living over there. And they have purchased in 2012. It's more than 5 years already there. Huh? Make sense? It's not necessary what is bold is right. This looks good to me. The couple is able to exclude up to $300,000 but is required to report the sale on their tax return. Everyone agree? Or anyone?
ये जो हमारा फर्स्ट रेजिडेंस होता है ना, प्राइमरी रेजिडेंस होता है, जैसे गेन हुआ जो, अगर जो वो विद इन द लिमिट्स है, एक्सक्लूजन लिमिट, तो वो हमें रिपोर्ट करना जरूरी नहीं होता.
यस, रिपोर्ट तो करना, रिपोर्ट इज मैंडेटरी.
रिपोर्ट करना जरूरी नहीं होता सर. आई थिंक इसलिए फोर्थ ऑप्शन को इन्होंने वो
सर एक बार इसका वो पढ़ लेते हैं, एक बार रूल पढ़ लेते हैं एक बार अच्छे से दोबारा से.
हाँ, नो, वी हैव ऑलरेडी looked at it. This, if you see the principal residence, so owned and occupied at least 2 out of 5 years by the taxpayer. In case of married filing jointly, either spouse should satisfy ownership requirement, but both the spouse should meet the occupancy requirement of 2 out of 5 years. So one side you can say like the information is incomplete in the question to reach to this conclusion whether they were saying 2 years out of the 5 years or not. Right? Under the divorce decree, you can, this is not relevant information.
9 साल हेल्ड किया है ना सर?
Yes. So yeah, they were there for 2012 to 21.
Yes. तो first जो condition है वो
So that condition satisfied, right? So if
Yes.
that condition satisfy, they can claim exclusion up to $500,000. So entire $300,000.
एक्सक्यूज मी सर, बट क्वेश्चन में ये नहीं है कि ये मैरिड फाइट ज्वाइंटली करते हैं, मतलब ये क्वेश्चन में थोड़ा पूछा नहीं, बताया नहीं.
No, that I agree, but considering the limited information they have given in question, to me this looks okay.
मान लेते हैं सर कि मैरिड फाइट ज्वाइंटली करते हैं, तो 5 लाख
500,000 is allowed.
में नहीं है 5 लाख का. तो 4 ऑप्शन में से 5 लाख कोई ऑप्शन ही नहीं है.
No, like 500,000 is maximum limit. But if your gain is 300,000, then you will claim only up to the gain only.
Okay.
Right? So let's go with this fourth option. But any other thought you guys have? Rajat, Shubham, Divya?
No, sir.
Got it?
थर्ड और फोर्थ में क्या फर्क है?
Reporting not required.
Okay.
So they need to report in the income tax return.
ठीक है सर. Okay.